I'd like to open the Audit Committee meeting for the month of April. First thing on the agenda is public comments. Do we have any public speakers?
Nope.
No?
Nope.
Okay, I need approval of minutes. I need a motion to accept the minutes as submitted. Second? All in favor? Carried. Audit Committee work plan. I don't think there's any changes. Is there, Mike?
No, we're good. No, Jim, it was on schedule for the work plan as stated.
Okay. Our next meeting is June 25th, and that's when we do the first quarter of the consolidated along with single audit and the investment plans, okay?
Correct.
So there's no changes in the plan. Okay, 2013 financial statements in draft.
Mike?
Mike, we're ready for you.
Good morning, Mr. Chair.
Good morning.
I feel like we took care of a few forests when we went through the reports this time, that we do have quite a lot of information that hopefully you did receive in advance. What I'm going to concentrate on myself is our communications to you as a part of the audit, and then I believe Pat and his team and Bob also have, an actual financial presentation. They'll go through some of the highlights of the actual financial statements, but I'll deal with the things that specifically related to our audit, if that is okay with you.
Good. Okay.
Our audit this year did incorporate separate financial statements of the First Mutual Transportation Assurance Company, the Long Island Railroad Company, Metropolitan North Commuter Railroad Company, MTA Bus Company, New York City Transit Authority, Staten Island Transit Operating Authority, and the Triborough Bridge and Tunnel Authority. All of those draft financial statements you would have received for your review. Our reports on those financial statements are unmodified opinions, and that's a new terminology that's similar to what you would have heard in the past, where I would have said in the past it was an unqualified opinion. Now we call it an unmodified opinion. So it's a clean opinion. We did have 3 financial reports where there were changes in accounting principles, and that related to the consolidated financial statements, the New York City Transit Authority, and the Triborough Bridge and Tunnel Authority. In those 3 reports, we had an emphasis of matter paragraph that related to the adoption of GASB 65. 65 basically now has a definition of what is a deferred inflow and a deferred outflow, and there were some adjustments that needed to be made to go in compliance with those. The biggest change was, in the past, you were allowed to defer debt issuance costs on bond offerings. So you were able to amortize those costs over the life of the instrument. GASB 65 said that's not really an asset, that's a cost of financing. So that was the major adjustment that basically took that off your balance sheet in the past and expensed it down against your fund balance. In accordance with generally accepted auditing standards, we did look at the financial statements themselves. We also looked at the internal controls as it related to the financial statements, but we're not issuing a separate opinion on internal controls like you might see in a SEC type of reporting entity where there's a separate report that an auditor issues. We also do look at the internal controls as it relates to the federal programs. We look at compliance as it relates to laws and regulations for the A133 audit, and we'll be reporting to you on that at a later point in time. In terms of accounting estimates, on page 2 of our presentation, I had shared with you previously what we deem to be the significant estimates in financial statements. That would include the market value of financial instruments, allowance for doubtful accounts, accrued expenses as it relates to potential obligations and legal liabilities, environmental liabilities, the pension liability, claims and judgments. You have some derivatives. None of those estimates were changed in terms of how we approached the audit. None of those estimates did we have any disagreement with management, and none of those estimates did management change in a process as to how they were doing that. So it's very consistent from year to year in terms of how those were calculated. On page 3 of our report, I'm required to share with you if we had any past adjustments as a result of our audit. There were no past adjustments. So our procedures, we were able to look at reconciliations, we were able to look at what management had done in their estimate process, and these financial statements reflect everything that we would have found over any trivial threshold that we do. I mean, we don't go down to the penny, but I mean, we do look at within our materiality standpoint. There were 2 adjustments that I have highlighted for you in the middle of page 3 as a result of the audit. The first one related to the MTA financial statements, and it has to do with how the accrual for unrecorded liabilities is done. The BSC basically calculates, or when they input information, they input the invoice date into the accounts payable system. They don't actually input the actual service date. And when we look at our audit, generally accepted accounting principles would say you really ought to be looking at what's that service date versus the invoice date. So we found in our sampling items that were primarily related to capital types of expenditures. So things you would capitalize on your balance sheet as an asset, but also have to record as a liability because you had received that asset, but you just hadn't been invoiced for it at year end. And when that was extrapolated, the amount of that calculation indicated there was about $105 million worth of assets that had not been recorded along with a corresponding liability. There was also, on an extrapolated basis, about $10 million of operating expenses at the MTA level, and that adjustment was actually then recorded as a result of our audit. The second item on that page 3 deals with basically just a classification in the balance sheet. Last year there was an insurance receivable set up for Hurricane Sandy proceeds, and based upon information at that time, it appeared that you could potentially get that within a 12-month period. However, you didn't, and it's expected that it may take a little longer for that to come in. So actually, there was an adjustment made in the current year financial statements to take it out of current receivables and put it down into long term. So it does affect your working capital, but it doesn't affect your total balances. So that reclassification entry was also made. In terms of significant accounting policies, I've already talked to you about GASB 65 in terms of the change that was made there. As a part of our audit, we do look at information that goes into offering statements. As the offering statements occur this next year, we will agree these financial statements into its related offering statement as that may occur. Page 4, other items I'm to share with you. No disagreements with management. We received full cooperation as a part of our audit. Schedules were prepared timely. Our answers to our questions were done timely, which allowed us to then to be in a position today to be able to issue these financial statements upon your approval. There were no consultations with other accountants about accounting principles. There were no significant findings that were discussed prior to our retention. We have included in Appendix B, which is the spiral binder for you, the management representation letters that we receive from all the various entities. And we're required under professional standards to share those with you. I can tell you the representations are standard in accordance with professional standards. There's nothing unusual in there. There were no qualifications by management when they made them to us, so we are comfortable with those representations as they've been made to us. There are also some emphasis of matter paragraphs, including the fact that in the other reports that basically say, for instance, that Long Island Railroad Company is a subsidiary of MTA. So that's what page 5 and page 6 talk about, or in terms of other things that are in our opinion that may not be in other types of opinions that you may see. And that really goes through page 8. And then on page 9 and 10, I do want to bring to your attention that we do have 2 significant deficiencies that we're sharing with you. And again, let me refresh your memory in terms of what that terminology means in auditing standards. You have 3 levels of types of comments that an auditor can make to you about internal controls. One is a deficiency, which just means we had an exception in our testing and we believe that there's a control change or a control process that management should make. There's a significant deficiency, which is one that is more material than just a basic type of testing exception, and something that we really think you should take seriously and potentially modifying your processes. And then there's also on the third, and that's the worst one, which is a material weakness. A material weakness is where if something is undetected, you could have a material error in your financial statements. These 2 items are not material weaknesses, but they are things that we wanted to bring to your attention for consideration of changes in processes. The first one deals with the $114 million error in the financial statements I mentioned to you earlier as it related to the accrual of capital expenses and some operating items. We believe that the BSC should consider including the delivery date or service date in a field that it captures when they're inputting that information. That will allow then the various agencies and headquarters to basically then just run a screen on that file and say, what was the service date, and compare it to the invoice date and payment date, and then they can actually automatically do their accrual versus the way it is right now. Pat, if he's doing it at headquarters, would have to go through and manually look at the invoices, do a sample or something of it, and it just is not efficient for him to have to do that. As you can see, by not doing that and including the invoice date, you could have, a fairly significant adjustment to your financial statements. The second item deals with some federal awards that were not included in the schedule of federal awards last year. There was some FEMA money, approximately $12 million, that had been received. It didn't run through the normal grant process. It went through the risk management process because it related specifically to Hurricane Sandy. Or Irene, okay, yeah, Sandy money's fine, but Hurricane Irene. And what happened was, since it was in risk management, nobody knew that it was a separate program that needed to be included in the single audit, that it needed to be then also included on the schedule of federal awards. The way we do our audit procedures, we're tying out the financial statements to the grant programs that your grant department has, so that therefore our audit didn't catch it either, but management also didn't catch it and include it on that report. That money will be included in our current year's single audit. We've talked to the federal agency and they're fine with that. However, there is something that, you have to look at, I think, for the future of making sure that all awards get basically, accounted for by a certain department, and then, they can be allocated out to various people. So those are the two items that we wanted to bring to your attention from an internal control standpoint. I'd be glad to answer questions.
Any questions?
Are you confident in your colloquy with management on these issues that they will resolve them?
Yes, I have had conversations with Bob and with Pat, and I do believe that they are taking steps to consider those.
Not consider, resolve them?
They need to put the steps in place. I think they are. I guess I'll leave it to Bob to answer.
We have no disagreement, so.
So steps will be put in place.
Okay.
The assets that you said were unrecorded, which were fairly sizable, were those assets on the books or were those physical assets?
What is construction?
Yeah, construction.
Well, the way this works is when they find an error, they do a statistical sample, and then they extrapolate that sample to a dollar amount. So the extrapolation resulted in that large capital accrual. So it's booked as construction in process. So in theory, it's an asset. It's construction in process asset. The theory is that there are probably other invoices out there that we have not included in our accrual. So it's, that part's all balance sheet. There's really no effect on the MTA's net position. So.
And they actually, this next quarter, they will reverse that entry, and then they'll actually, as the items get, actually processed, they'll then be recorded. So it's more of an accrual type of item.
Any other questions? Let's go to management.
Okay, we'll walk through an overview of the consolidated financial statements for December 31st, 2013. The MTA's consolidated financials are prepared on an accrual basis in conformity with GAAP as applied to government units. The consolidated financial statements include 5 sections. There's the MD&A, Management Discussion Analysis. There's the financial statement themselves. Statement of net position, which is our assets and our liabilities and our net position. Well, then we have the consolidated statement of revenues, expenses, changes in net position. And then we have the statement of cash flows, the notes to the financials, which show our accounting policies and various schedules that support the financials. The required supplementary information, there's two requirements by GASB, the Government Accounting Standards Board, and that's the MTA's progress on funding its pension obligations and the progress on funding the OPEB, or post-employment benefits to retired employees. And fifth, we have additional supplementary information which is required by New York State, which is a reconciliation of the audited financial revenues, expenses, and changes in their position to the financial plan actuals that were presented earlier in the year. So first, we'll take a look at the MTA's consolidated assets for 2013. Consolidated assets and deferred outflows of resources increased by $2.8 million, or 4%. Majority of that increase is in capital assets. One new item here is in deferred outflows of resources. Because of GASB 65, as Mike had mentioned, we now have, we include in there unamortized net refunding losses. Previously, those were included in our debt, so those numbers were sort of moved on the balance sheet from the liability side to this new category under GASB 65. So looking at the, sorry about that. Looking at the increase in the fixed assets, we have significant increases in construction in progress, and buildings and structures and other assets. Just taking a look at some of those categories, we have the East Side Access, continued progress on the mega project, 2nd Avenue, Fulton Street, number 7. So that's the majority of the construction in progress. Various infrastructure work, various passenger station work, including the South Ferry Terminal, and various signal communication projects incurred by the MTA Transit Authority, the railroads. Okay, next we'll look at the other assets and deferred outflows. So other assets are cash, investments, receivables, other current, non-current assets. Cash increased by $125 million. Investments increased in total by $759 million, and that's comprised of increases to unrestricted investments of $982 million, increases in restricted investments of $179 million, offset by decrease in capital lease-related investments because we're closing out a lot of these capital leases, so we have offsetting investments for those, and as we close the liabilities, we're also basically giving up the investment asset on those. Receivables decreased by $211 million. Other assets decreased by $691 million. A lot of that is GASB 65, which there's two effects there. We have, as Mike mentioned earlier, we have prior year accumulated bond issue costs that previously were included as an asset. That's now been basically written off to net position, and going forward, that becomes an expense, an ongoing expense. In addition to that, there's $119 million of unamortized refunding losses that again were included elsewhere that are now included as deferred outflow of resources. Deferred outflow of resources increased by $350 million, largely because of the two items I mentioned. In addition, in there we have the change in the fair market value of our derivative instruments, our swaps. So that fair market value decreased by $295 million for the year. Okay, next we'll look at our liabilities. Our total consolidated liabilities increased by $4.3 billion. Our debt went up $2.2 billion. Long-term debting, basically we had new borrowings of $5.2 billion, offset by refundings and retirements of $2.6 billion. And then we had the reclass of unamortized bond refunding losses of $459 million, and again, it's under GASB 65. So you see a lot of GASB 65 impact on our balance sheet this year. Other post-employment benefits, our OPEB liability, that increased by $1.9 billion as a result of a new actuarial valuation. So that difference represents the OPEB expense for the actuary, 2.4 billion, less what we paid in. So we paid in on a pay-as-you-go basis, 456 million, and then we contributed to an OPEB trust this year of 50 billion. So last year we contributed 250 million, this year we contributed 50 million. So the net of that is our increase in liabilities of 1.9 billion. Accounts payable increased by 669 million. Estimated liabilities for injuries, our claims increased by 253 million. Part of that was transit increase in claims. FIMTAC had an increase of 63, and Metro North 37 million. Those were related to the derailments on Metro North. And then we offset by decreases at the other agencies. Other long-term liabilities decreased by 662 million. Primarily due to the decrease in the capital lease obligations as we close those leases. So there you see the decrease in the liability. Before that, we saw the decrease in the corresponding investments to those lease obligations. Next, we have our net position. So the net position is basically our assets. It's the difference between our assets and our liabilities. So in total, our net position decreased by 1.5 billion, and we break up net position into restricted categories. So we have net investment in capital assets that increased by 864 million as a result of basically a $2.5 billion increase in net capital assets offset by related liabilities. So debt, we have some accruals in there. So the net of that is an $864 million increase in our net position for capital assets. We have restricted for debt service. That increased by 61 million due to basically new borrowings. We have our net position restricted for claims. That decreased by 41 million due primarily to an increase in FIMTAC loss reserves related to MTA Metro North train derailments. And then we have net position restricted for other purposes. That decreased by 314 million, due largely to a decrease in investments related to capital leases, offset by an increase in other restricted investments. And then finally, we have our unrestricted net position, which decreased by $2 billion. And, you know, primarily that decrease is really related to the increase in the OPEB liability. So if you look at our cumulative OPEB liability of about $10 billion, it pretty much is responsible for that $9.3 billion cumulative unrestricted net position. Okay, next we'll look at our revenues, expenses, and change in net position. So operating revenues were up by 632 million. Total operating expenses before depreciation were up by 790 million. We had asset impairment and related expenses this year of 93 million versus negative 132 last year. But last year had the insurance recovery of $775 million. So that was all recorded in 2012. So this year the asset impairment is strictly asset impairment and then related expenses related to that. We had grants and appropriations for capital of 1.6 billion, a decrease of 827 million. So total net position for the year decreased by $1.5 billion. Take a look at our cash flow. Our cash flow, again, was positive this year by 125 million. Looking at the major categories, cash flow from operations was positive by 1.3 billion. Our cash flow for non-capital financing activities was positive by 511 million. Our net cash flow for capital and related financing activities decreased by 106 million. And then our net cash for investing activities declined by $1.6 billion. So basically that investing is is the investing of all the positive cash flow from operations. So overall, it's a pretty good picture for the MTA's cash flow for 2013. Okay, next we have our first required supplementary information, and this is the funding of our single employer pension plans. And there are three: Long Island Railroad, MAPSTOA, Metro North. And basically, the combined funded ratio is the same as last year, 50%. And you can see on the individual plans there, basically, the Long Island Railroad one is 24% funded. Although we did fund $80 million this year to the Long Island Railroad plan, that's not reflected in these numbers because the actuary report is at the beginning of the year, so we will see the effect of that additional funding in the next year's report. MAPSTOA is the same, 65%, and Metro North is 100% funded. Next, we have the funding progress on our OPEB liability. So for this year, you do see the actuarial value of plan assets. So this is the first time that we're seeing this. We did contribute $250 million in 2012, and at the point that this was valued, which was at the beginning of the year, at that point in time, the value of this asset was $246. So offsetting that is the actuarial accrued liability of $20.2 billion. So our net unfunded liability is $19.9 billion, and funded ratio is 1.23%. So as we continue to contribute to the trust, we should see that funded ratio improve on our OPEB liability. We did put another $50 million in 2013, which is not reflected here. And then finally, we have our final supplemental information, which is the reconciliation of the financial plan to our GAAP financials. And in total, the total net operating deficit was $179 million higher than what was presented in the financial plan. Does anybody have any questions?
Any questions?
Well,
We've got a lot of information,
Yeah.
short period of time to answer.
Okay. Well, that concludes my report.
Okay. I just, I looked at a couple things in the last day after I got these. And one of the things that struck me was in comparing the Long Island Railroad and Metro North. Many years ago, we decided that we were going to try to make these consistently so we can compare them. But as I go through line items, I find that they're not exactly, I mean, you can't sit them side by side and compare them. And the question I have after all these years of trying to get to that consistent position, or why haven't we done that, and where are we with that?
You're talking about the P&L, the revenue and the income statement?
Revenue,
Right.
we'd like to look at them and say, okay, we have two
Right.
railroads, they
Right.
should be
This year,
comparable.
I think for the first time, Metro North changed their format to conform to the consolidated format. The Long Island Railroad has not done that yet, but we are working on it. So that's kind of a work in process. So I think the next set of financials you'll see, we probably will have them all in conformance. I think, it's just a matter of time. So we've been working with Metro North because we've automated the consolidation. So we have all the roll-ups automated, so we shared that with Metro North. They made the change this year, and we're working with Long Island Railroad to make the change for them. So I think by the next set of financials, we should see everybody in the same roll-up, the same format.
Okay. Any other questions? I need a motion to accept the financial statements as submitted.
Second.
All in favor? Approved. Thank you. Okay, next on the agenda, Lamont.
I'm sure this is everybody's favorite time of the year. I'm sure everyone's finished their taxes, and now you can do your financial disclosure statement. We sent out notices to all employees who are required to file a financial disclosure statement, as well as our board members as well. We sent it out this year via email to make sure that everyone received the notice and could not claim they had not received that notice. In years past, we had done mail drops and things of that nature, but we decided to finally get into the modern age and email it to everyone. Also this year, we, as you probably know when you saw the notice, we do have some employees who have potentially not filed their financial disclosure statements from last year. If you look on page 14 of your book, you will see that there are potentially approximately 438 individuals who may not have filed their financial disclosure statement from 2012. I say potentially because we know historically that oftentimes there are issues with individuals leaving and the update not taking place in a timely way from the MTA to the Joint Commission, so they are retired, they have left the MTA, but they're still showing up as being delinquent. There may be also duplications as well. So we are actively working on trying to identify who those employees are, because at this point Albany is not able to share the names of those individuals with us, but we are sending out notices and reminders. We are running an ad in MTA Today advising anyone that if you have not filed and received a notice that you didn't file, that we expect you to do so immediately. So hopefully that number, and we do anticipate that number, will come down significantly by the time the actual notices of delinquency are issued by the Commission.
Is Jacob making an effort to communicate with these individuals?
Jacob sends out a notice that they believe is confidential to the employees, saying that you did not file. From that point, they were supposed to have 15 days before they actually receive what's called a delinquency notice. The Commission has not issued the delinquency notices as of yet, but nor can they share with us who those employees are, so that we could reach out to them personally. So, but we are doing our best to do so.
Include termination of employment if you don't file?
Our Code of Ethics indicates that failure to file is a disciplinary offense, and it could be anything up to and including termination. So is it a possibility? Yes. Is it something we would do? I think that would be on a case-by-case basis, and we would have to work with HR and labor relations in terms of making that kind of determination. And we have disciplined employees in the past for filing and filing late, but we have not terminated employees for that at this point.
Now, how have you disciplined them?
We've had employees who have been fined, and we've had employees who have received reprimands.
You've actually fined them?
Yes.
And does MTA collect the fine?
It is more of I should say the fine, I should say it's more of a reduction in pay.
Reduction
That may be a
in pay.
more appropriate way of saying
Yeah,
it.
well, you've got the leverage to do that.
Since this is confidential, at what point do you find out about it?
Unfortunately, we will find out their names when the rest of the world does. When Jacob issues a notice of delinquency, they will go out to the public. I will receive a copy as well as the agency president, and then it will be posted on Jacob's website indicating this employee of the MTA has not filed. So we will not know until everyone else knows. But again, we sent out emails to everyone who has to file, telling them that they needed to file. If they were delinquent, they needed to resolve it immediately. And then obviously when those notices go out, we will look at it, because I do honestly believe there will be a substantial number of them that we will be able to resolve as being employees, for example, who are on an extended leave. If they're on FMLA, that's a reason for them not to file, but they may not have, Jacob may not have been notified of that. So I think we'll be able to resolve a lot of those issues that way.
Okay. Any questions on this? I just have one thing for you. I know that we've been doing some work with internal controls. Can you just give us a quick update as to how that is being implemented?
Oh, okay, yeah. We have been actually going through a process in which we have been automating the internal control process. Historically, the MTA would manage its internal control program, its inventory of business processes with their associated risks and controls on Excel spreadsheets. And I think we have made substantial progress in moving away from that. At this point, the internal control program for headquarters, including the BSC, is fully implemented. So when you go into the system, it's called GRC, Governance, Risk, and Compliance. You will get a complete inventory of business processes at headquarters and the BSC with their associated risk controls, audit recommendations, corrective action plans, all listed in one system, so that we can look at risks, and we can look at controls in a myriad of ways that we've never been able to do before. So that's fully implemented at this point. Metro North is also fully implemented at this point. They are testing their controls within the system, and their business processes are fully documented as well. Long Island Railroad is substantially on its way. We've completed training for all of their staff, and they are in the process of loading up all of their controls into the system, as well as the bus company as well. So they've all made, I think, very good progress. Bridges and tunnels will be fully implemented by the end of the year. We still have to do training for them as well, but we anticipate they'll be fully in by the end of the year. And that leaves, obviously, New York City Transit, which has the largest paper program of all. We have been in contact with Subways, and Subways has been working on implementing the program and getting their information into the system as well. And we did have a meeting with the controller for New York City Transit to discuss the implementation of the rest of the program for the rest of transit.
We think that that's going to be moving. I know it takes time to do, but
I've been assured by, and Transit is here, and I think they can, really speak for themselves, but I've been assured by Transit that, we will work on getting them fully implemented. Part of what we're also doing right now, as you know, we're in the middle of an IT transformation as well. So all of those associated business processes, risks, controls, tests, audit recommendations, all of those that are existing now in independent silos within the agencies are all going to now have to be consolidated to headquarters. And one of the lessons that we learned, unfortunately, from the transition with the BSC was that we need to do this in a very logical way. We don't want a situation in which a control, especially a key control, is supposed to be tested, but in that handoff, like in a race, you're doing that handoff, the baton gets dropped. So we are also in the process of working with each of the agencies on making sure that as that work is transitioned from the agencies to headquarters, that we don't drop any of those type of things. But in terms of transit, I mean, we are going to work with them in terms of full implementation. And I believe, is there something you want to add to that?
We're planning on implementing it also. We have a very large program, so it requires a lot of planning ahead to get ours put into place. But we've started the process now, so we're trying to determine how long it would take to go through the entire process to get a business plan put together for implementing it. But we also need to coordinate with the IT to get the resources we need to get all the licenses in place and the training. So we're in the process of putting together a business plan for that.
okay. Any questions for Lamont? Okay, Mike, you're up.
Good. Next one, advanced procurement.
Oh.
Oh, I'm sorry. Oh, your presentation, here's the presentation. Lamont has been, sorry about that.
It's quite all right. Okay. So this is the annual presentation on the MTA's compliance program, focusing mostly on its ethics component. Just to make sure everyone understands, our compliance program contains multiple components. It can, well, it's a little blurry. Investigations, corporate governance, ethics. We are actively involved in several key regulatory disclosures, obviously compliance and internal controls, which we just discussed. This is that kind of governance, risk, and compliance model that I talked about briefly just a second ago. As it relates to ethics issues, MTA's Corporate Compliance Department handled over 500 ethics or compliance issues last year. We have been seeing a steady increase in the number of inquiries that we have received, and we're actually very happy to see that people are coming to us with their questions and issues so that we can resolve them rather than finding out later in the paper that there was something we could have done to prevent it. Again, a lot of things are still coming in via email and telephone, and our ethics helpline is receiving several calls a year as well. We are actively involved in dealing with prohibited source-sponsored events, outside activity approvals. Those are individuals who have outside employment, gift issues, the financial disclosure we just discussed, and reimbursement for travel expenses and honoraria. Last year, we received a new mandate from the Joint Commission on Public Ethics that we had to provide you with JCOB ethics training. So last year, we provided that training to over 5,294 employees in less than 8 months. We did that via webinars to ensure that when we had to report to the governor's office our compliance numbers, that we would try to have as high a compliance rate as possible. At the end of the day, I believe we reported that of those employees that needed to take the required training, only 11 MTA employees did not have the required training. So considering that we only had 8 months to get it all done and get everyone in, I think that was a pretty phenomenal number for us. We continue our communications effort. The Code of Ethics is distributed to all employees upon hire. We will be doing a distribution again this year. We do distribute those hard copy, and that will be going out later this year. We still post it on the MTA's internet. We are also translating it this year. We translate it into Braille. We're also translating it into Spanish this year at the request of some of our employees, and is given to all new employees. The code is maintained and updated as necessary, and we can have ongoing discussions regarding modifications. Another thing that we've started doing is doing more communications with senior management on ethics and ethics issues. Each month, MTA Today is dedicated to ethics. We are currently using videos to engage employees on discussions on ethics issues. They are humorous as an ethics issue can possibly be. But the idea is to try to take some of the boredom out of the lecture and to really engage people in a discussion. We are also distributing on a regular basis 2 publications to all senior management at the MTA. It's a magazine called Ethicos. It's a business ethics magazine. We send that out via email to all MTA employees, and we also are distributing Tone at the Top, which is, again, a very good publication on ethics, internal controls, compliance, and risk issues. We are, again, still sending out memos to all our employees on the holiday gift issues, honoraria, special events, code of ethics. Again, the key behind all of this is that we do have an active communication program on these issues. We are publicizing the availability of our ethics helpline, that employees can call us. They don't have to identify themselves, and they can ask the questions that they want to ask, and we hopefully can provide them with the help they need to resolve their issues. And we do a great deal of coordination with the Inspector General's office, audit services, the agency ethics officers, the joint commissions. We're working very closely with corporate communications, human resources, and our legal department. So all in all, I think we have a very robust communication program in place for our compliance and ethics program, and I can answer any questions that you have about it at this time.
Any questions for Lamont?
The training that we underwent, the ethics training, is that a yearly thing or is that a periodic thing?
That's every 3 years.
Every 3 years.
Right. What will happen in about 3 years, you'll get another email from me saying it's time for you to take a seminar, and then we'll make arrangements for you to do that in about 3 years. But don't worry, we have a record of it.
Seminar from the training session?
Well, you had the it's supposed to be an update, which we haven't received yet. But what you did was the comprehensive ethics training. The seminar will be just a update on what has changed since then. That's what we've been told, but we haven't seen it yet.
Any other questions? Okay.
Thank you.
Good.
Mike.
Now I'm up. Yes, we have two procurements to go over with the committee. One is to obtain approval for Deloitte to perform the audit of the MTA Retiree Welfare Benefit Plan, which Pat Kane will give you a brief update on. And the other is the permission to go ahead and do a solicitation for independent integrity monitor as it relates to Sandy money. I'll talk about that one first. As part of a recipient of FTA funds for Sandy-related money, the FTA requires that any recipient over $100 million be required to hire and use an independent monitor. MTA Audit Services and the IG's office is taking the lead to audit these funds, but I have to have a contract in place should my reviews determine that I would need the services of such a monitor, that I'd have them at my disposal. So I would like permission from the Audit Committee to start the procurement solicitation process to obtain some firms that we could have on call that we could use over the next 3 years should the need arise for them to perform some special investigative services or monitoring activities as relates to the expenditure of Sandy-related funds that the MTA is expending. I expect up to $3 million over the next 3 years. Doesn't mean I'm going to spend the $3 million, but should we need those firms, they would be available.
Why don't you tell them what the expected cost was going to be?
The FAA did, early discussions required that we expend up to $40 million of Sandy-related money as part of, since we do have a robust internal audit activity at the MTA as well as an IG. We were granted permission to take the lead on auditing those funds. We created an independent Sandy-related unit within my office with 8 auditors dedicated to doing nothing but auditing Sandy-related expenditures. And as a result, we were able to reduce the required expenditure, which is 1% of the expected funds. On this case, almost $4 billion, would be $40 million, down to around $3 million.
Is that, what you just said, is that duplicative of somebody else in the department doing that as well?
No. It's
You're the only ones that
the
do it.
only one we're doing, yes, independent. And because of my relationship with the Audit Committee, as we do report to the Audit Committee, it was agreed by the FDA that we could perform such activities then. But no other self-auditing within the agencies.
Any
So-
questions? Can I get a motion to second? All in favor? Any opposed?
And the last Audit Committee meeting discussion was made about whether to audit a remaining pension fund, and Pat just give a brief overview on that one, so Deloitte could do that review.
Yeah, this is the OPEB trust. I think at a prior meeting, Jim, you had asked about financial statements for the OPEB trust. So currently, it's got about $300 million in it, plus probably some investment earnings. So, but the trust document does require an audited financial statement. So we're going to need Deloitte to do the audit for that OPEB trust.
Okay.
And the item was negotiated by our procurement department directly with Deloitte, and it's in line with the cost with what we've been charged for the other pension funds that they audit.
Okay.
It's around $43,000 something to perform that review.
Any questions? Can I get a motion? Second? All in favor? Any opposed? Carried. Okay, I'd like to make a motion that we go into executive session.
Before we do that,
Yes.
when last we met, I asked a question about the governance of all of our various and sundry pension boards. Do we have an answer on that yet?
What we'd like to do is, at the next audit committee, is give you an overall presentation. We're in the process of consolidating all of our pension functions, be it accounting, administration, and such. We're about ready to go out with a chief investment officer position that will then take that function. But we'd like to present to you exactly what we have in each of the charters for these to show positions. And I think we're going to have some recommendations for you to consider on how we think the overall governance of each of the positions should be. But that's what we'd like to do, is give you a presentation at our next audit committee.
I have no
mean,
objection to that. I
yeah.
mean, Mr. Chairman, I think in advance of that, I would like to see who is on these boards.
Yeah, no, we can certainly get you
That's
that
not a
information.
State secret
Yeah.
or anything,
No, it's
right?
not. We can get you the information on that.
Thank
But
you.
again, one of the things that we did put in motion even before that last conversation was this consolidation, because we just think it's very important.
Understood,
So-
but in advance of that, well in advance of that, getting
We can
an
get-
indication of who the...
Yeah, we
who
can get it
these-
to you this week.
Great, thank you.
Sure.
And we'll schedule that for the June 25th meeting, the presentation.
And I think I mentioned a number of years ago, I sat as a representative of the board on each of those pension boards. But it got to be too time-consuming, along with the other responsibilities you have. So to my knowledge, right now, there is not a board member sitting on any of those boards. So that's something we might take into account and how we want to remedy that. 'Cause I think the board needs to know, or have a representative that understands at least generally what's going on. Okay? Okay, can I get that motion to go into executive session? Second. All in favor? Okay, let's clear the room. Thank you.
When's the filing deadline?